Hello and welcome back to The Note. Well, conversation here in New York continues to be dominated by British exits. Most of the English friends I have here are now discussing England's ignominious exit from the European Soccer Championships at the hands of Iceland. Everybody else is still trying to assimilate the extraordinary vote last week by the United Kingdom to leave the European Union. There is no great sense of any rebound at this point, even if we're not in true panic stations. People aren't as despondent as the England soccer players were, but there is still great concern. Now, perhaps the most important number we need to look at, if we take a look at this first chart, is the 10-year Treasury yield, an exceptionally important number as it sets the effective risk-free rate for transactions across the world. As you can see, we are now almost back to what appeared to be an enduring all-time low or post-war low for the 10-year Treasury set back in 2012. We are now at this point looking at a situation where we are within a few basis points of going through that level. That implies a quite remarkable flight to quality, a flight to havens at a point when the direction of interest rates should, of course, be up rather than down. Now, that provides some strength, of course, for the stock market. As ever in these days, bad news at least means that there are less likely to be rate rises from the Fed in prospect. But if we take a look at this next chart on the S&P 500, the main index for the US stock market, this chart goes back to the point when the Fed finished tapering off its QE bond purchases back at the end of 2014. You can see it's been stuck in a range ever since. We've seen two very sharp corrections since then. What we are seeing now appears to be the third biggest downward draft, the third biggest fall in share prices since then. In every case, we got very close to that all-time high set in the spring of last year. Again, now that we're below the 200-day moving average, which is a good measure of the long-term trend, this implies that we are once more going to see a move in a range. What is less clear is whether we're truly going to see a move down towards the bottom of the range, as we've seen twice in the last 12 months. Now, there are indications of elevated concern. If we take a look at this next chart, this shows you how the S&P 500 Dividend Aristocrats index, an index of stocks that have a particularly high and reliable dividend yield, has done compared to the rest of the market. Bear in mind this excludes the effect of their higher return from the dividends. This excludes the dividends, which obviously would be higher. You can see that their price has been very significantly better performing than the S&P 500 as a whole, and that there has been a sharp rise, a sharp continued hunt for yield today. It's very hard to justify yield-bearing stocks at this kind of levels. These are very boring, safe stocks, which are now not cheap at all. But in an environment where yields are so low, where anxiety is so high, they continue to ramp up. Another very important indicator that things are not all well with the market is bank stocks. Now, we've seen a very ugly sell-off in US bank stocks today, including a lot of banks and brokerages which really should have little or no exposure to the UK and the Eurozone. You can see what's gone on. We're not even looking at the UK banks here. You can see what's going on with Japanese banks and particularly with European Eurozone banks. This goes back to the day when Fannie Mae and Freddie Mac were put into conservatorship, a moment of extreme alarm about the US financial system back in 2008. And you can see that since then, the Japanese and European financial systems have inspired much, much greater pessimism and alarm, particularly in the case of Europe. Any time when banks aren't offering leadership is very worrying. It's very hard for stock markets to put in a significant rally when banks are subject to such concern. Now, does that mean we're going to get a bounce back, which you would normally hope for after a big sell-off? Outside of the UK and the Eurozone, the areas most directly affected, there plainly has to be a good chance of that. Within the UK, for foreign investors, there appears to be further downside for sterling, even if there does appear now to be a chance that Brexit isn't going to happen. There's also plenty of downside for stocks. The people I've been talking to suggest that it's simply not going to happen. So as it stands at the moment, we don't have Armageddon, we don't have panic, we are more at the bottom of ranges once more in the US, but there is no reason for any great confidence or any great sense that a rebound of any significance is coming.